Hey guys, it's Nick from Financially Aware, and in this video I want to talk about the Tesla $5 billion stock offering that they're doing and explain what they're doing. They're doing it at the market instead of all at one price like they normally do. So I'm going to talk about what that is and why I actually think it's a really great thing for Tesla and even not a bad thing for stockholders, as long as you're okay with buying this stock and holding it at a 1200 PE. This secondary stock offering should have almost no effect on you if you're a stockholder. So normally with a secondary stock offering, they do it all at one price, and they do a road show where they go around to all other institutions and pitch the stock and answer any questions and stuff like that. They're not doing that in this case, and there may be a few reasons for it. One is maybe they don't think there's a lot of institutional interest at these levels, and maybe they don't want to answer the tough questions like why an institution should buy Tesla stock when it has a 1200 PE. So they're going the easier route by selling it through these banks like Goldman Sachs, Bank of America, Wells Fargo, that are gonna just ease the stock out at different times, not all at once, and it will probably mostly be mopped up by retail investors who ask a lot less questions and just like a pretty story about Tesla going up, and that's all they need to know. So that will be a lot easier for them, and their fees will probably be a lot less. They're only paying half a percentage point to these banks. So on $5 billion, that's only about $25 million in fees, which the roadshow way would probably be a lot more, and they would have to offer a discount if they did it all in one shot at one price. Now, why is this a good thing for Tesla and even investors? Well, for one thing, their stock is up like crazy, and it cost them nothing to sell this stock. So their market cap is like 455 billion or something like that. This sale would represent only about a 1% dilution in their shares. They have about 930 million shares outstanding. This $5 billion at a price of about $500 a share is only like 10 million shares. So that's about a 1% dilution to the existing shareholders. So if you're an existing shareholder, you're only getting diluted by 1%. But on the flip side, you're getting the positive aspect that they're pocketing $5 billion for their war chest for their business. And Tesla has something like $7.8 billion in long-term debt. So this $5 billion could wipe out a good portion of that long-term debt, or they could just use it to build more factories and stuff like that for their business. So this cost them almost nothing. They don't have to go to the debt markets, which they have to pay back, and they could go bankrupt if they can't pay the interest on the debt. This money is free, no strings attached. So it's good for Tesla, and it's good for shareholders if they're already okay with owning the shares at these high levels. So even though I think this offering is good for Tesla and its stockholders, kind of, I still think the stock is way overpriced. Crazy PE is ridiculous, and this is going to end badly for most people. But let's look at some of these numbers and compare what this actually means and show you where Tesla makes most of its money. Okay, last year, 2019, their sales were about 25 billion. So this $5 billion stock offering is 1/5 of just their sales of all of 2019. And they did a $2 billion stock offering in February. So they raised $7 billion, or almost about a quarter of their last year's sales just by selling stock. And just in the second quarter of this year, their revenue was $6 billion. So think about that. They're selling almost as much stock as all their sales for the second quarter of this year. And their earnings on that $6 billion was $100 million. So they are selling 50 times more stock than their net earnings for last quarter. Okay, and those earnings aren't really earnings, because if you know, $428 million of their so-called net income was from selling government credits for the zero emission vehicle credits to other car companies that don't make enough zero emission vehicles. So they actually sold credits, which shows you that if they didn't sell those credits, they would be losing about $300 million on the quarter. So what's their best selling item? Is it flamethrowers? Is it solar panels? Is it electric cars? No. Their number 2 best-selling item is selling zero-emission vehicle credits, right, to the tune of $428 million last quarter. But their number 1 profit maker is by far selling stock to the public. And so they did $7 billion of that this year. And just to give you an idea of what that means, last year they sold 367,000 cars, something like that. If you take the $7 billion that they sold in stock this year and divide it by the cars, they sold about $20,000 in stock for every car that they sold last year. Think about that, okay? The Tesla 3 sells for, I don't know, $30,000, $40,000 on the low end. So they're pocketing in stock sales almost half of the cost of that vehicle for every one that they sell. Okay, so until they really start making profits and all of that, Tesla is really a company that makes most of their money by selling ideas, which enables them to sell stock to the public. Now the PE of Tesla is above 1,200, and I know people don't care about that anymore. All they care about is that the stock is going up, it has a great story, and the comments I see in my videos is, you misunderstand Tesla. It's not a car company. You can't compare it to Toyota. It's a technology company, and they are a technology company that makes self-driving software. That's where the real money is and all that. So the numbers don't matter. It's a new paradigm, blah, blah, blah. Everything's different this time. Let me explain what 1200 PE means. 1200 PE means that you are willing to plunk down $1,200 today for $1 a year back on your money. Okay? You know what that means? If Tesla does not grow their earnings at all, let's say they have the same amount of earnings from now till infinity, it would take you 1,200 years just to break even on your money, not counting for inflation and all of that stuff. Okay? Think about that. And for Tesla to grow their net income by, to get down to like a PE of the S&P 500 of 25 or something like that, they would have to grow their net income by like 60 times, okay? And right now, most of their net income is coming from those zero emission vehicle credits. So it would take a lot of growing, not only of their revenue would have to be astronomical, but their net income would have to grow 60 times just for you to have a regular 25 PE. So to put that in perspective, imagine looking at a pizza place that was having a profit of $100,000 a year. And one pizza place had a profit of $100,000 a year, and they were selling at that S&P price, which is expensive right now, of 25. Okay, you could buy that pizza place for $2.5 million and get 100 grand a year in profits. The Tesla pizzeria, on the other hand, would also be making $100,000 a year in profit, but they would be selling that pizza place for $120 million at a 1200 PE. So, which pizza place would you rather buy? Even though the Tesla pizza place maybe says that in the future they're gonna have some kind of AI software that's gonna make the pizza and make you eat it as well or something like that, that's way off in the future, and there's no guarantee that they're going to make money on that. So how much money are they making now? That's a different story. So that's what Tesla looks like in terms of their valuation. But in terms of this secondary stock offering, I think it's a great thing for Tesla and not even a bad thing for shareholders. In fact, if I was Tesla, I would try to sell even more stock while this thing is up here crazily. Sell 10 billion, sell 20 billion, sell 30 billion if you can. If the market will absorb it, I would say do it. I don't know if they're going to do that, but you know, they're testing the waters with this 5 billion. I'm sure if it goes smoothly and the stock stays up high, they'll probably sell some more just to shore up their balance sheet. So that's a look at the Tesla secondary offering and why I think it's really not a bad idea for Tesla or its stockholders, but I still think the stock is crazily overpriced and I wouldn't touch it, but people are making crazy money on it anyway. So, you know, it's your decision what to do on whether you should buy it or not. I'm staying away and I'm not making any money on it, obviously. So if you like this video, give me a thumbs up and leave me a comment on if you're a shareholder and if you view this secondary offering as positive or not. And as always, please subscribe to my channel if you haven't done so already. Thanks for watching.